Good evening. This is Ken Long from Tortoise Capital Management with the executive summary of the weekend reports for January 15th, 2011. As you can see, we're in bull quiet mode. We're at overbought conditions on the annual weekly RSI at 74 and overbought on a 10-day index basis at 99 out of 100. The percent stretch above the 200-day moving average is highlighted as green, very bullish. Slope of the 50-day moving average at 0.77% is also very bullish. ADX at 34.4 for SPY is getting near the extreme of normal for trendingness. That's closer to the end rather than the beginning of bullish moves in SPY. So this is a alert to ensure that your stops are honored, that they're in place. It's unusual for SPY to remain above 34 for long periods of time. So 34 is quite strong. ATR percentage at 0.75% keeps it in quiet, but it's up from its low of the last couple years at 0.50. So we got another 10 to 15% or 0.15 to go before it gets back into normal conditions. The U.S. indexes have continued to cool off a little bit, and we're seeing strength come into Asian and emerging markets. Precious metals and commodities have cooled off, although energy and finance remain strong as sectors. U.S. technology and financials, along with energy, are still very strong. Monthly rebalancing and quarterly rebalancing continue to hold the NASDAQ 100, U.S. mid-caps and U.S. small-caps, with the next reevaluations due on 1 February and 1 April, respectively. ETF2 theoretical exposure is at 100%, and the model portfolio also is at 100%. There's no new buying or selling. 8 of the 10 positions made new highs this week, and so all of those position trailing stops are raised. In the market health check, what we're looking at is a very narrow band for the 30-day regression line. You can see the 3 parallel black lines. The vertical blue lines are 10, 20, and 30-day look-back periods, respectively. The red horizontal lines are support levels and resistance levels from previous price action. And as you can see, our next support level is at about 126.5, then 125, then 123.5. Price is well above the 20-day moving average, which is the green line, which is above the 50-day moving average, which is the red line. You can see how it held support here back on the 1st of December and has never looked back since. The 200-day moving average is not even on the chart here. It's at 114.34. On the 10% Williams percent R10, you can see that we dipped back into normal on January 10th and have gone right back into overbought conditions. Again, on the Williams percent R annual, we continue to be overbought, and powerfully so. ADX, you can see, is at 34.4, and the difference between plus DI and minus DI is as pronounced as it has been in the last 6 months, and that's the classic definition of a runaway bull market. But again, with ADX at 34.4 and the slope of the regression line as steep as it has been in the last 6 months, we want to make sure that we're prepared for any change of the intermediate term trend. Summary of the ETF2 Regional Report. U.S. sectors and Japan are all overbought on a weekly RSI, and all the strength is in the U.S., as you can see. The strongest is U.S. technology, followed by mid-caps, then by technology, then small caps, then mid-caps, and the weakest regions being Asia less Japan and the Euro-Asia blend. With all 10 indexes above in the green in the 5-week rate of return, the model portfolio is at 100% invested, 10% cash. The extended world market model details, we take the same indexes. We add semiconductors and some commodities. You can see that the strength in technology is related to the strength in semiconductors, SMH. The energy sector in both the U.S. spiders and in the global are both very strong. And you can see that the next strongest moving up here is XLF Financials. Industrials and materials still doing pretty good, but XLF, the financials, have made the biggest gains. In a graphic of the world market model, you see the U.S. is kind of stuck in the middle here with just a little bit of weakness in the Dow and large cap value. Strength in certain countries in Asia, and these were the leaders in ETF2 last summer, and so they look like they're regaining their form. Malaysia, Taiwan, and South Korea. India is suffering the most in the world right now and is an opportunity possibly for bottom feeding. Western Hemisphere, Mexico, Brazil, and Canada are kind of on par with the U.S. in the white, slightly above average. Europe is lagging. Let's see, gold, treasuries, and corporate bonds are lagging, along with U.S. real estate and oil. You can see the energy sector is by far the strongest sector in both the U.S. and the globals, and financials are coming in second place now, after having been beaten down for a long time. Almost everything in the 100 by 200 crossover system is on a buy signal. The exceptions being real estate, Europe, and the utilities, the defensive sectors. So that's a globally strong bullish market. In the ETF2 database, the top 30, we've got commodities, grains at the top, Malaysia, agriculture, agribusiness, oil and gas exploration, some technology, coal, NASDAQ 100 tech index, energy, South Korea, oil and gas, energy, home construction, Taiwan, oil services, oil equipment, U.S. energy. Silver has dropped down to the bottom of the strong sectors, and you can see on a strength rating it's pulled back below average now on this last 8 to 9% pullback. So there is some definite sector cycling going on here. The same usual suspects, good for intraday trading. We're looking at highlighted in green are those that have exceptionally volatile intraday volatility, and these are the top 25, also by average daily dollar volume. So highlighted in green are the ones that are better for intraday. So metals and mining, oil, gold miners, oil services, and Brazil are the best for intraday trading on a pure volatility basis, and because of their high daily dollar volume are very liquid as well. So you're going to get good spreads. ETF2, we've already seen those numbers in the model portfolio. We have no changes to be made. Everything that we own is still in the green on 5-week rate of return. Everything is above average on the average and on the strength ratings. And we've caught back up to the S&P, and the only action required this week is to update stops. And these are the new stops. And that's a summary of the Tortoise weekend reports. Thank you very much for your attention.